If October 10th was the shot, February 5th was the funeral. That message started appearing in institutional terminals the first week of February. No sender, no explanation, just 7 words that made institutional desks stop trading. Somewhere out there, someone was dying. Not a person, something bigger, a structure, a $19 billion bet that had run out of time. Today, we are going to find out who. Not with rumors, with evidence. Every investigation starts with a body. Ours showed up on February 5th, 2026. That day, BlackRock's iShares Bitcoin Trust recorded $10.7 billion in volume, nearly double the previous record. But here is what made analysts stare. The fund had net inflows. Money was coming in. Yet the price crashed. In a normal market, that is impossible, unless the selling wasn't coming from investors. At the exact moment Bitcoin broke $69,000, silver futures collapsed, and a Nasdaq crypto stock suffered its worst day in history. 3 markets, 3 unrelated assets, moving in perfect lockstep. In market forensics, we call this a fingerprint. It only happens when a single balance sheet is being liquidated across multiple positions simultaneously. Someone wasn't selling because they wanted to. Someone was selling because they had to. We don't have the name, but we have the blueprint. The data profiles this entity as non-crypto native, old money in new markets, active during Asian hours, heavily exposed to TradFi derivatives. This wasn't a trader, this was an architect. Layer 1, the foundation. Borrowed Japanese yen, near zero rates, the carry trade. Layer 2, the leverage, IBIT options, regulated rails, portfolio margin, leverage ratios of 10 to 1, maybe higher. Layer 3, the hedge, precious metals, gold, silver. The thesis: the Fed keeps printing, the dollar keeps debasing, metals go up, 3 legs, tightly correlated, and when one breaks. Rewind, 4 months before the funeral, October 10th, 2025. That day, crypto recorded $19.16 billion in liquidations in 24 hours. For context, COVID crash 2020, $1.2 billion. FTX collapse, $1.6 billion. October 10th, nearly 20 times larger. But the disturbing part wasn't the total, it was the speed. $3.21 billion, vanished in 60 seconds. $19.2 billion, evaporated in 40 minutes. That is not selling. That is an execution. The trigger was geopolitical. US-China tensions. For a Hong Kong entity with exposure to both markets, a kill shot. Their leveraged positions wiped, but they didn't die. The prime broker granted a 90-day grace period. For 90 days, this entity existed as a zombie position, technically dead, but still walking. From October to January, the zombie did the only thing it could: double down. They levered into precious metals, specifically silver. Why silver? By early 2026, the ratio of paper contracts to physical silver reached 356 to 1. That is not a market. That is a casino on a fault line. And regulatory data showed 22 major banks holding a massive short position. The whale wasn't just betting on silver. They were betting on a short squeeze against the biggest players in the world. They had reason to believe they would win. Washington signaled support for critical minerals, price floors, strategic reserves. The whale read it as a government backstop, a safety net from the top. They were wrong. Then the Fed pivot, January 30th. A new chair nominee, a known hawk. The signal was clear. No more easy money, no more infinite printing. Hard money was coming. The market understood instantly. No more Fed put. No more infinite printing. Hard money was back. Within hours, gold down 11%, silver down 31%, the worst single-day decline since 1980. Then, the kill shot. CME raised silver margin requirements by 50% in 1 week. The whale's collateral evaporated. Their hedge, now a liability. The 90-day clock expired. The prime broker had no choice. February 5th, the day the machines took over. Not emotion, not opinion, just code, executing margin. No headlines, no announcements, just a quiet instruction to begin systematic liquidation. By close, $10.7 billion in volume, $900 million in options premium. Bitwise CIO Jeff Park explained, classic negative gamma. When options positions close, dealers sell the underlying to stay hedged. Selling begets selling. A doom loop. That is why the ETF had inflows, but price fell. Investors were buying. The machines were selling faster. IBIT, silver, DFDV, one entity, one balance sheet, one funeral, $19 billion, not lost, not stolen, mechanically executed. We don't have the name yet, but we will. 13F filings drop February 14th. We will be scanning for a Hong Kong-based fund with a massive IBIT position at year-end 2025. If that position vanishes in Q1 2026 filings, we will know. Here is what we know for certain. This wasn't a Bitcoin crash. This was the funeral of a leverage structure built for cheap money that died in a regime of hard money. Markets don't kill you because they are scary. Markets kill you when you are forced to act. Market signals does not predict. We reconstruct. This wasn't a crash. It was a mechanical execution. If October 10th was the shot, February 5th was the funeral. February 14th is the autopsy.